Hi, this is CH. This video is part of a series of videos titled My ABCs or Absolutely Biased Comments to share how an individual investor like you and I can try to find out more about an investment fund from public sources and do some basic research or simple due diligence before deciding to buy the fund or walk away. Do explore the other funds covered in this series and subscribe to the channel if you find this video useful. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the HSBC GIF Ultra Short Duration Bond Fund. This video is done as a follow-up request from a viewer's comment in my previous video covering the Fullerton Short-Term Interest Rate Fund. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos and I'll be happy to work on it as long as I can find enough information on the product. HSBC Asset Management or HSBC AM is a business arm of the Hong Kong and Shanghai Banking Corporation, or better known as HSBC. HSBC was founded in 1965 and today is one of the world's leading financial institutions, with majority of its businesses in Hong Kong and UK. The asset management business falls under its international wealth and premier banking segment in the current organization structure. HSBC AM serves both internal clients from its own banking business and as well external global clients just like other typical fund providers. It currently manages over $730 billion of assets and hires over 660 investment professionals. Product offerings are comprehensive, covering equities, fixed income, and multi-asset solutions. Alternatives and private market solutions are, however, not key offerings. There is not much information on the business, and I can't find details on the AUM breakdown across product types. So, I'm not sure how big is the piece of the pie for bond fund solutions. The HSBC GIF Ultra Short Duration Bond Fund is one of three short duration bond fund solutions offered by HSBC AM. The other two are HSBC GIF Global Short Duration Bond Fund and HSBC GIF US Short Duration High Yield Bond Fund. That third one was previously a global strategy but was changed in July 2023 to have a US focus. There was a fourth fund called HSBC GIF ESG Short Duration Credit Bond Fund, but it was just recently liquidated, so we can ignore this one. HSBC AM used to promote these short duration bond fund offerings actively and had nice looking sales brochures like this one in 2022, but I can't seem to find any updated ones now. Nevertheless, the brochure did provide a quick summary of each fund to highlight the differences. The Ultra Short Duration Bond Fund is stated as primarily a credit bond fund, meaning it focuses on corporate bonds and probably not much in government bonds. As the name implies, it appears to control the portfolio duration at a very low level. It uses both fixed and floating rate securities. Floating rate notes typically have near zero duration and is crucial for such strategies with a duration objective. The Global Short Duration Bond Fund is stated as an aggregate bond fund, meaning it invests across all types of bonds from government and government-affiliated to investment-grade and high-yield corporates to emerging market debt to local currency plays and so on. The 1 to 3 year benchmark should be referring to duration as well, so this takes on a slightly higher duration limit than the Ultra Short Duration Bond Fund. The US Short Duration High Yield Bond Fund, as the name implies, is a high yield bond focused solution, but goes for shorter duration exposures. The allocating to high quality issuers probably means it will avoid defaulting and defaulted restructuring opportunistic plays. So, as you can see, there are different ways to create a short duration bond strategy, and these three approaches are from HSBC AM alone. The different strategies do have their own pros and cons. We will focus on the Ultra Short Duration Bond Fund in this video, but we will do a quick performance comparison amongst these funds later. The HSBC GIF Ultra Short Duration Bond Fund is a sub-fund under the HSBC Global Investment Funds, or GIF in short, fund family. HSBC GIF is set up as a Luxembourg SICAV company structure and is UCITS qualified. Singapore-wise, the fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. The HSBC GIF Ultra Short Duration Bond Fund is co-managed by Jason Moschos and Viral Desai since inception in 2021. There is, however, zero information on these two managers in the HSBC AM website and fund documents. Even Morningstar doesn't have the updated bios of these two managers. All we can gather is that Jason has 19 years of industry experience, while Vera has 6. This is not great, as the lack of information gives investors low assurance on the capabilities of the managers. Both the fund webpage and fact sheet provide similar contents for investment objective and policy, though the webpage version has no paragraphing and is difficult to read. Nevertheless, both are referring to the prospectus for a full description, so we'll skip this and go straight into the prospectus. The first paragraph states the fund aims to provide short-term total return, which relates to the short duration nature of the strategy, and also that total return means the fund considers the sum of capital appreciation and income generation as the key returns objective, instead of prioritizing one over the other. The fund invests in bonds as well as money market instruments, which is a normal coverage for bond funds. There is also an ESG objective here, where the fund aims to have a higher ESG score than the reference benchmark, which is kind of a pointless objective, and I'll explain why shortly. It is stated here that the reference benchmark is Barclays 1 to 3 year US Corporate Index Total Return US Dollars. Now, this is an outdated name, as Bloomberg has acquired the index business from Barclays Capital many years ago. Now, the Bloomberg US Corporate 1 to 3 year Index, as it is called now, is slightly different from the fund's strategy. The index covers only investment-grade, fixed-rate US dollar corporate bonds with 1 to 3 year maturities. Given the difference, the fund doesn't even use this reference benchmark for portfolio construct or performance comparisons, which makes this benchmark rather irrelevant. Additionally, this benchmark doesn't even care about ESG factors, which makes the ESG objective of the fund irrelevant as well, because it is meaningless to have a higher ESG score than a benchmark who doesn't care about ESG. Anyways, let's forget about all that ESG stuff and move on. The fund is expected to have an average duration of less than 1 year. This is why the fund has an ultra short duration in the fund name instead of just short duration. The next few paragraphs cover some investment guidelines. The fund is expected to have at least 70% invested in investment-grade fixed-income bonds and floating-rate bonds, as well as money market instruments. This also implies max 30% in high-yield bonds, which is mentioned below. There is also a restriction of max 10% in a non-investment-grade sovereign issuer. This highlighted sentence is quite rubbish. Issuers which are domiciled in developed or emerging markets basically covers the entire world. This follows by multiple paragraphs covering ESG in the investment process, which I will skip since I find this objective pointless. The next few paragraphs continue on the investment guidelines. The fund is allowed to invest max 10% in bonds with more than 5 years maturity. I don't really see this as a necessity, as the duration constraint should automatically keep long maturity exposures at a minimum. The fund is also allowed to invest max 30% in emerging markets, of which max 10% in onshore Chinese bonds. Additionally, the fund is also allowed to invest max 20% in securitized assets such as ABS and MBS. It is also mentioned the fund may have a high allocation in financial sector. This is expected for corporate bond portfolios and more so for those with floating rate bond exposures, as banks are the main issuers for these bonds. There is also a mention of max 10% in COCO bonds. The fund can also invest max 10% in other qualified mutual funds, which is a common feature for most bond funds to get an easy and diversified exposure through another fund, usually from the fund provider's own offerings. The fund can hold equities as a result of corporate actions, though it is not stated how soon the fund should get rid of them. There is also a paragraph covering usage of derivatives for efficient portfolio management, which is common for almost all mutual funds. The fund is base currency in US dollars and allows for max 20% non-US dollar exposures. There is also again a paragraph stating the reference benchmark is just for comparing the fund's ESG score, which I mentioned earlier. I find this pointless. Finally, it is stated the fund is expected to have 25% securities lending. With so many investment guidelines, let's see how this translates to the actual fund portfolio. The HSBC GIF Ultra Short Duration Bond Fund was launched only a few years ago in June 2021, but already has over $4 billion of AUM, which makes it a pretty successful product for HSBC AM. I'm not sure how the investor breakdown of the AUM looks like, but given the nature of the fund strategy, it can potentially be used as a cash plus allocation in HSBC's discretionary mandate offerings as well. In fact, the fund grew about 1 billion in AUM in the month of May alone when compared to the April factsheet data, so this fund is clearly gaining quite a lot of traction among HSBC clients and beyond. The portfolio currently has slightly over 1,000 holdings, which is normal for bond funds of this size. Average coupon rate at 4.48% and yield to worst at 4.90% looks slightly above the current US Treasury yields at around the 1-year curve. Average portfolio maturity is at 1.32 years. Coupon yield should comprise the majority of the fund's returns, as we wouldn't expect much capital appreciation for a low-duration, low-maturity bond portfolio. Option-adjusted duration at 0.45 and modified duration to worst at 0.46 is way lower than the 1-year duration limit defined in the fund's investment strategy. The fund holdings are nearly completely in investment-grade issues, with nearly half in single A rated. This gives it a pretty high credit quality for a corporate bond-focused strategy, as most corporate bond funds tend to overweight BBBs to get slightly higher yield. Maturity breakdown shows the portfolio has bonds with varying maturities up to around 4 years. One important disclosure that has gone missing is the amount of floating rate bonds in the portfolio, which would help provide some clarity on the duration handling in the fund. Referring back to the 2022 brochure again, the fund had about 41% of the portfolio in floating rates, of which slightly more than half are corporate bonds, while the rest are asset-backed securities or ABS. Now, for a quick 101. Floating rate bonds have a coupon yield that is variable and tied usually to a Fed funds rate or Treasury rate benchmark index, and it gets reset typically every 3 to 6 months. As a result, floating rate bonds have low sensitivity to interest rate changes, and therefore their effective duration are very low. A fund like this would typically need to have a sizable allocation to floating rate bonds in order to get the ultra short duration requirement. It would be useful if HSBC AM can add this data back into the fund webpage and factsheet again. Coming back to the portfolio construct again, I don't know why the geographical allocation has to be in a bar graph format in the factsheet when everything else is in a data table format. Sometimes this little weird stuff in presentation formats irritate me. Anyways, the portfolio has about 62% US exposure, while the rest are scattered across Europe, Australia, and Japan. There is about 6% in other locations, so while the fund allows for it, there really isn't much exposure in emerging markets. Sector allocation-wise, banking takes about 35%, which is expected as banks are significant issuers in the corporate bond space. The portfolio is almost fully exposed in the base currency US dollars, so there is minimal FX risk in this product. Top 10 holdings don't really mean much for a fund with more than 1,000 holdings, though we can already see the importance of floating rate bonds in this strategy, with the top 2 holdings being US Treasury floating rate notes. There is also no disclosure on the usage of leverage, though we can get a little bit of data from Morningstar that shows the portfolio is just slightly levered at the moment and shouldn't be of concern. The HSBC GIF Ultra Short Duration Bond Fund is a strange product offering when it comes to share classes. The normal retail share class for HSBC AM funds is A class. For this fund, there is accumulation US dollar and Sing dollar hedge A classes available. A class has a 0.4% management fee, and adding other expenses comes to a TER of 0.55%. However, for some reason unknown to me, HSBC AM decided to offer the A retail share classes only to institutional and accredited investors in Singapore, as per stated in the share class fact sheet. What is offered to Singapore retail investors instead is the P share class that has a lower 0.3% management fee and 0.45% TER. Now, having a lower fee share class is obviously good news for retail investors, so I'm not complaining here. P class comes in a variety of currency hedge classes besides the base US dollar class, including Sing dollars, Aussie dollars, Euro, Sterling, Hong Kong dollars, and Renminbi. It also comes in both accumulation and monthly distribution versions. P class does come with an additional requirement that is a minimum $1 million initial subscription. Now this may sound impossible for individual retail investors, but since the fund is normally offered via distributors such as banks and online trading platforms, this minimum requirement is usually applied on the distributor's nominee account basis, so it is easy to achieve. For example, assuming Standard Chartered Bank offers this fund, Standard Chartered Bank will have a Singapore nominee account that handles the investments on behalf of all the retail investors booking in Singapore. As such, Standard Chartered Bank just needs to ensure that it can consolidate at least $1 million from all its clients interested in the fund under the Singapore nominee account to place the first subscription to fulfill the requirement. Fund providers can sometimes also waive off such requirements for select distributors. Up to 70% of the management fee may be paid by HSBC AM to distributors as trailer fees. The fund allows for up to 3% subscription fee to be charged by distributors. Although, considering this is expected to be a low-return bond fund, I suggest to ask for a waiver on the subscription fee. To find out about distribution information of the HSBC GIF Ultra Short Duration Bond Fund, the best source is the Dividend Distribution Record Excel document found under the Documents section in the fund webpage. The document contains the past 12 months of distribution data for each share class for each fund. In this case, this example is the PM2 US dollar class. Here, we can see that the share class has been reducing the dollar value of the distributions through the past 12 months, resulting in a decline in the annualized distribution yield from 5.97% a year ago to 4.77% as of end March 2025. We can also see that part of the distributions are paid out of capital, which is not ideal as there is probably hardly any capital gains for such a strategy in the first place. The change in distribution yield over time is correlated to the change in the portfolio yield to maturity, which has been declining in the past year given the Fed fund rate moved down in the same period. Looking at the distribution yield across currency share classes, we can see clearly that the currency hedging costs are factored into the distribution. For example, the PM2 US dollar class has a 4.77% distribution yield, while the PM3 Sing dollar hedge class has only a 2.89% distribution yield. The 1.88% difference can be taken to refer to the hedging cost of the Sing dollar class for the past 12 months. One more thing to take note is that the price history chart that is available in the fund webpage shows us that the fund is trying to keep distribution payout as high as practicable without impacting NAV. In this example using the PM2 US dollar share class, we can see the NAV is maintaining at around the $9.9 through the past 2 years, and the zigzag movement shows the fund is paying out pretty much all the capital and income gains every month. Hopefully, the fund will continue to maintain this approach when the interest rate environment changes. Performance information for the HSBC GIF Ultra Short Duration Bond Fund is rather limited. Firstly, because the fund was only incepted in 2021 and therefore doesn't have a long track record for us to assess its behavior through market cycles, and also the fund doesn't have a proper benchmark to be used for comparisons. What the fund webpage and fact sheet tells us is that the fund had slightly negative returns since inception in 2021 to around mid-2022, followed by a rather steady return of about 5 to 6% per annum since then till date. These are two very different performance periods, and as investors, we obviously want to figure out what is really a more sustainable and realistic returns target to expect from this fund on a long-term basis. Let's first compare the fund against the two other HSBC short duration bond offerings. Here, we can see both the Global Short Duration Bond Fund and the US Short Duration High Yield Bond Fund went through a bit of correction of around -6% and -10% respectively during the period of early 2022 to mid-2023. Now this is of course due to the steep 5% US interest rate hike during this period. However, do bear in mind that these are all short duration strategies, so only the ultra short duration bond fund managed to avoid notable losses by keeping duration below 1 year and as well use floating rate bonds to offset some of the downside risk with increased floating rate coupon use. From 2023 onwards, the ultra short duration bond fund exhibited a similar return but with lower volatility compared to the global short duration bond fund. So purely based on performance perspective, I think the ultra short duration bond fund is a better solution. The US short duration high yield bond fund takes on a higher risk, higher return profile, so it is expected to have a slightly different behavior. Ultra short duration strategies are quite uncommon in the mutual fund space, so I think easier performance comparisons might be these two: the iShares US Dollar Ultra Short Bond UCITS ETF and JP Morgan US Dollar Ultra Short Income Active UCITS ETF. While both are ETFs, iShares is a passive strategy and JP Morgan is an active strategy. iShares has a really low 0.09% TER and has a decent AUM at $2.2 billion US dollars. JP Morgan has 0.18% TER and a smaller AUM at $0.6 billion US dollars. I find these two products more relevant for comparison here as both have lesser than 1 year of effective duration. Here are the performance data extracted from the respective fact sheets. We can see here HSBC has slightly better calendar year returns in 2023 and 2024, leading to a better 3-year annualized return. Year-to-date and 1-year returns are slightly lower than iShares and JP Morgan though. Overall, I think the performance among the three are quite comparable. We can also take guidance from the longer track record of iShares and JP Morgan to get a feel of how HSBC might perform in a declining interest rate environment, such as 2019 and 2020, as well as early phase of near zero rate environments such as 2021. The 5 to 6% per annum returns of the last 2 years will not be sustainable if interest rates decline further or if significant market stress kicks in. Without going into strategy details, I think among the three, HSBC has the advantage of the largest AUM and is also suitable for investors looking for a mutual fund structure or with different currency choices. iShares would be more suitable for investors looking for a very low fee passive ETF, while JP Morgan would be suitable for investors wanting to try out active ETF instead. For Sing Dollar investors, it is even harder to find comparisons. If we use the usual low-duration Asian or Singapore bond funds, such as United Sing Dollar Fund and Fullerton Short-Term Interest Rate Fund, you will find that they have also gone through a bigger correction in 2022, as their duration are relatively higher. However, another better alternative is money market funds, such as the Fullerton Sing Dollar Cash Fund, where you can see it has delivered near identical returns as HSBC GIF Ultra Short Duration Bond Fund, but with even lower volatility and no drawdown. With that, let's summarize the HSBC GIF Ultra Short Duration Bond Fund. HSBC AM is not among the largest fund providers globally, but it does have a stable client base supported by the very strong overall banking business of HSBC. With several attempts on short duration bond strategies, the Ultra Short Duration Bond Fund appears to be an attractive proposition currently. Whether we are looking at performance delivery or the ability to gather AUM from investors, the fund has done better on both aspects compared to other HSBC products in the same category. The fund provides a detailed investment strategy in the prospectus. It would, however, be good if HSBC AM can include floating rate exposure details in the fact sheets similar to the old sales brochures. Given the fund was only incepted in 2021, the performance track record is a bit short to understand how the strategy would perform through different market conditions. Performance, especially past 2 years, have been very decent, and is probably a primary reason for the fast-growing AUM. Investors, however, need to understand that performance can and will fluctuate according to market conditions, and the 5 to 6% per annum in the past 2 years is on the high side of the performance range. Investors also need to understand this is not a capital protected solution or a money market fund. The fund can have negative returns at times, though it should not be excessive if the strategy is managed well. In conclusion, I think the HSBC GIF Ultra Short Duration Bond Fund is an attractive proposition for investors looking for low risk and low volatility global bond funds and want to minimize impacts from uncertainties in the interest rate environment going forward. This concludes my absolutely biased comments on the HSBC GIF Ultra Short Duration Bond Fund. Again, if you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.